Hello everyone, and thank you for watching my videos. In this video, we're going to talk about Japanese candlesticks. And we're also going to learn just how important they are in helping us become successful Forex traders. Now, let's talk about the history of Japanese candlesticks. As I mentioned previously in my video, that Japanese candlesticks were developed by rice traders in Japan during the 16th century in order to determine the value of their rice. If you would like more information on the history of Japanese candlesticks, you can read this book, Japanese Candlestick Charting Techniques. Now, in the 1990s, many investors, both in the stock and Forex markets, realized just how valuable this information is in determining trends and places to open a position. So, the candlesticks charts, they are very, very useful in helping us become successful investors. So we must learn as much information as we can from these charts. Now, in the previous video, I showed you these two bodies, so let's do a review. The rectangular areas, those are the bodies. And the wicks that are above and below the bodies, those make the shadows. Now, the white body symbolizes the bull market, the black body symbolizes the bear market. As we can see on the white body, the open is on the bottom and the close is on the top, vice versa with the black body. Now, let's look at parts of the candlestick. Here we have pictures of the bodies. On the left, we have the short bodies of the bearish and bullish candlestick. And on the right, we have the long bodies of the bearish and bullish candlestick. The difference between the short bodies and the long bodies is volatility. When we see a short body, it means that there wasn't much action in the session and the bears and the bulls were indecisive in regards to who wants to control the market. The long bodies, however, indicate that there was a lot of action in that trading session, and the long white body shows that the bulls are definitely in charge, and the black body symbolizes that the bears are in control of this market. So, as we can tell by now, we get more than technical analysis from the candlesticks. We also get a little bit of fundamental and sentiment analysis as well. So, let's talk about shadows. On the left, we have a bearish candle with a long upper shadow. This tells us that at one point during the trading session, the bulls were in charge and tried to raise the volume as high as they could until the bears came in to push down the volume. And however, the bulls did show enough resilience to keep the prices up. So that's why we have the shadow on the bottom of the body. But as we can see, the sellers took control of the market. On the right side, however, we have a long lower shadow. It meant that at some point, the sellers were in definite control of the market until the buyers stepped in to push the prices upward. And at the end, the buyers eventually won. So just by looking at the bodies and the shadows, we have information as to what happened during each trading session. Now, let's talk about basic candlestick types. So, these two candlesticks are called spinning tops. What this means is indecision. It means that the bears try to control the trend, but then the bulls stepped in because they wanted to control the trend, but at the end, the close was near the open. And same thing with the black candle on the right. These two bodies are called marubozu bodies. because there are no wicks. Marubozu tells us who is definitely in charge of the market. When we see a bullish Marubozu, it means that the opening and the low was at the same place, and the close and the high, they were both at the same place, which means the bulls are definitely in charge. Vice versa with the black Marubozu, in which the sellers are in charge. Now, here we have different types of doji. Doji is a Japanese word for saying. Here we have indecision. Here in these four pictures, the open and close are at the same place because the buyers and the sellers were not able to control the trend during each session. So here, let's start with the one on the left. We call this the long-legged doji. It just means that the buyers and the sellers were at equal strength during this trading session. Part of the trading session, the buyers were in control. Part of the session, the sellers were in control. But at the end, there was no clear winner. So the result was a tie. On the second, we have the dragonfly doji. It just means that the sellers were in control during most of the market. However, the bulls came in to push the market upward. So the buyers were strong during this session, but they were defending their volume, whereas the sellers were clearly on offense. Now let's move to the gravestone doji. The gravestone doji is the opposite of the dragonfly doji. It just means that there was a lot of volatility in this market. The buyers were strong, the sellers were strong. However, this tells us that the buyers were on offense and the sellers were on defense because the open and close were at the bottom. And then on the right we have the 4 price doji. It tells us that virtually nothing happened in the market, because if something did happen in the market, there would be shadows. So the open, the close, the high, and the low, all 4 were at the same place. So it was a boring trading session. Sometimes we'll see these. So let's talk about a long white candle with a doji. What does this mean? Well, we see these in a bull market where we have rising candles, and then we have a doji where the open and close are at the same place. And even though we had a lot of action in the previous section, there wasn't too much action in the current session. And then if we look to the right, we have the same thing. A lot of action in the previous section, but not so much action from the bulls in the current session. As a matter of fact, we see some action from the bears more than the bulls, the sellers more than the buyers. So when we see these patterns, that could be a clue that the bull market is about to end soon, and that the sellers are about to take over. Or it could mean that the buyers are just running out of strength, and the market may not be able to move as high in the future. So now we have a long black candle with a doji. In this session right here, we have some indecision. We don't see the sellers taking control of the market in this session. However, we did see some defensive moves from the buyers trying to prevent the market from going down too far. So this pattern just might tell us that the end of the bear market is upon us. And also, here's another example of a long black candle with a doji. And in this session, which is different from the previous session where the bears were definitely in charge, here we see the buyers trying to take control of the market, but they don't have the momentum that the sellers have. So the sellers were able to push the prices down. However, the sellers were not strong enough to continue their offensive positions. Now, let's talk about single candlestick patterns. Here we have the hammer and the hanging man. On the left, we call this pattern the hammer pattern. Now, notice that the hammer is a bullish hammer inside a bear market. We call this the hammer because, well, for two reasons. Number one, it looks like a hammer, and number two, it appears that the buyers are hammering out a line of support, so the sellers can't take the market down too far. So and as we can see, the buyers are beginning to take control of the market, and this hammer is acting as a new line of support. Also, we have a hanging man. Now, the hanging man is similar to that of the hammer. Here we have the sellers trying to hammer out a line of resistance so the buyers can't take the price of the market up too high. So when we see the hammer and the hanging man, those are good indications that the trend may reverse. Now, here's what we need to know about the hammer. The long shadow is about 2 or 3 times of the real body, and there really is no upper shadow. There shouldn't be an upper shadow. If there is, maybe a small one or an insignificant one. And the real body must be at the upper end of the trading range. And the color of the body is not important. It doesn't matter the colors, it just matters the shape. Here's what we need to know about the hanging man. A long lower shadow, which is about 2 or 3 times that of the real body. There is little or no upper shadow. If there is, it's an insignificant one. And the real body is at the upper end of the trading range. Okay? And the color of the body is not important, just like the color of the hammer is not important as well. Now, let's talk about the inverted hammer and the shooting star. On the left, we have an inverted hammer. And it works like this. Here, we have a downtrend. The sellers are in control of this market. But the buyers want to have control of this market too. So instead of hammering out a line of support, they're going to go straight to the offense and start driving the prices upward. But the bears are still strong and they can keep the prices down. And however, as we can see, the bears have eventually tired out and a new trend is beginning. And then also in the bull market, we have a shooting star, which the concept is similar. It just means that the prices have been moving very high and the sellers want to step in and lower the price. However, there does come a time when the bulls run out of steam and the bears step in to begin a new trend. Now, let's talk about dual candlestick patterns. Here we have an engulfing candle. Engulfing candle means the candle that comes after is bigger and takes over the body of the previous candle. Here we have a black candle and a white candle inside this circle that I drew. Notice that the white candle's body completely covers the black candle's body. This is significant because this tells us that a trend is about to reverse. and that the bear market will now become the bull market. Let's look on the right. Here we have the black body, which is bigger than the white body in this circle. This means that the bulls are tiring out, and now it's the bear's turn to take over. Now we have tweezer tops and bottoms. Now, when you look at a pair of tweezers and compare that to this circle, well, they look like tweezers. And when we see tweezer bottoms, this tells us that the trend may be reversing soon. And here we have a bearish market on the left, the two tweezers, and now we have a bullish market. On the right, we have tweezer tops. We have a bearish trend, the two tweezers, and now, we have the bullish market, the two tweezers that I indicated with the circle, and then the bearish trend going down. Okay, now let's discuss triple candlestick patterns. Morning stars are important when we read a Japanese candlestick chart because morning stars are an indication that the bullish market is about to begin. So we look for a small doji at the end of a strong bearish candle. Now, I say strong bearish candle because the bears might have exhausted much of their energy to keep the prices low. They don't have enough energy to make the prices lower. So thus begins the morning star. And then the evening star, the same concept as the morning star. And notice that the evening star comes after a strong bullish candle. Here we have a bullish Marubozu after or right before the evening star, which gives us an indication that the bulls are running out of steam in order to push the prices as high as they want, and now it's time for the bears to take over. Okay, next we have three white soldiers. When we see three bullish candles at the end of a downtrend, this tells us that the new trend, this new bullish trend, is for real, and that the market will be bullish in the future. And when we see three black crows at the end of a bullish trend, tells us that the sellers are taking over. Three inside up. When we see a bearish candle with two bullish candles, that can also tell us that the trend is reversing and the trend will now be bullish. Same thing with a three inside down, but with the opposite effect. When we see a three inside down at the end of a bullish trend, that tells us that the bearish trend is about to begin. Now, let's do a review. We have the spinning top, as I mentioned before. This tells us that there was some volatility during the trading session, but also some indecision as far as who is going to control the market. On the left, we have a white candle, which tells us that the bulls eventually took over this market after the bears have shown a lot of their strength. And we have a black candle on the right, showing that there was a big struggle between the buyers and the sellers, but the sellers stepped in and took control of the session. So we want to pay attention to the spinning tops because that can give us an indication as far as when and where a trend might end, or when and where a new trend might begin. We're going to see many dojis in our charts, so we need to take some time to familiarize ourselves with these bodies. And as we can see, on the right, the horizontal line, that tells us that the open, close, high, and low were all on the same number, meaning there was no activity in this market. And the other three dojis tells us that all even though there has been some battling between the buyers and the sellers, there really is no clear winner. So, the white Marubozu, this is a bullish signal. When we see this candle, it tells us that either the bull market has begun or we are in the middle of a bull market. So we're probably not going to see too many of these as much as the dojis, but when we do see this candle, it does give us a clear indication that we are in the bull market. And the same applies to the black Marubozu, which gives us an indication that we are in the seller's market. And we also talked about the hammer. So when we see this pattern, think about this. The sellers, they're trying to push down the market as far down as possible, but the buyers have stepped in, even though at this point the buyers don't have the momentum that the sellers have. However, they have enough strength to hammer out a good line of support. And the hanging man, that is the opposite, but the hanging man gives us a bearish signal, meaning the buyers are trying to raise the price as high as possible, but the sellers, they see what the buyers are doing, they've stepped into the market to hammer out a line of resistance so the buyers can't push the price too high. Inverted hammer, this gives us a bullish signal. This tells us that the buyers are beginning to flex their muscles in a seller's market, but at this point, the sellers are still too strong. So the buyers, they're staying in the market, defending that line of support, and just waiting until the sellers run out of power, and then the buyers can step in and reverse the trend. Shooting star, this is the opposite of the inverted hammer. This is a bearish signal. Again, the buyers are controlling this market. However, the sellers are stepping in and getting ready to flex their muscles. However, they need to set up a line of resistance in order to make sure that the bulls don't raise the prices too high. So the sellers are stepping in order to defend that line of resistance, wait for the buyers to run out of steam, and then the sellers will take over. Bullish engulfing. So here in this circle, we have a big white candle that has completely covered the smaller black body. This is a clear indication that the bear market has ended and the bull market has begun. And then we have the bearish engulfing, which is a bearish signal, as you can guess. We have a big black body engulfing the previous white body, and that tells us that the bull market is finished, and here comes the bear market. Tweezer tops. This pattern right here tells us that the trend is going to reverse. So when we see two tweezers, two shadows that are on top, and the highs are almost similar to each other, it tells us that the resistance is really strong and the buyers don't have enough strength to penetrate that line of resistance. And then when the buyers run out of steam, the sellers will come in and drive the prices down. And the same thing with the tweezer bottoms. The buyers are just getting into the market to set up the line of support, wait for the sellers to run out of momentum, and then the buyers will step in and take charge. Morning star. A small doji at the end of a large bearish candle tells us that the bear market has ran out of power, and here come the bulls. Same thing with the evening star. The buyers, they've pushed the price as high as they could, but as soon as they've ran out of steam, here come the buyers to push down the prices. Three white soldiers. This means we have three bullish candles beginning the bull market trend. Three black crows. which is the opposite. This tells us that the bear market has begun. We have three strong black bodies pushing down the prices. Obvious bear market. Three inside up. This tells us that the trend is in the middle of changing direction. And as we can see, when we have a black candle followed by two white candles, this tells us that the trend might go from seller's market to buyer's market. Three inside down. One bearish candle followed by two bullish candles. It tells us that the bull market will now be a bear market. So, here's what we've learned so far in this video. We've learned that we can combine candlestick charts along with the support and resistance lessons that we've learned in the previous video, and we can make our predictions in the market more accurately. And also, we've learned that the candlestick charts can give us more than technical analysis. We can even get some sentiment analysis as well. Now remember, candlestick charts aren't perfect, and the Forex market is just like any other market. Nothing is certain. So just because we know everything about support and resistance, combine that with everything we know about Japanese candlesticks, that doesn't mean we will win every time. We're still going to lose. So watch my next video, and we're going to talk about mathematical formulas and calculations, and we're going to use math in order to improve our chances of having successful open positions. Thank you for watching this video, and good trading.